Ladies and gentlemen, thank you for joining us again on Become the Banker. My name is Jordan Quijano, and I'm here to show you on really how the Become the Banker strategy works. Why is it set aside from any other product, any other investment? And that's what today's video is about. So let's assume that you built $20,000 of cash inside your account. Now that you know it's life insurance, of course there's a death benefit on there to keep everything tax-free. And let's assume that maybe it's just $100,000 of coverage. To us, that's secondary. The primary focus is this right here, your living benefit. So let's assume again that you built $20,000, maybe you did it with a lump sum, maybe you built it up over the months. However you got there, you've got $20,000 of cash growing at 4%, tax-free, and again, recession-proof. Now we want to use this money though. This is what sets it apart from anything else. You have access to the money and you don't have to pay penalties. You actually have liquidity access without any penalties. And the best part that I'm about to share with you is your money still grows even after you think you've spent it. So to run with this, assume that you have a $10,000 purchase. Maybe it's a new vehicle, maybe it's to pay off some credit cards, whatever it is, you've got $10,000 of debt that you want to pay off. Well, most people would assume that if you take that money out, it would come straight out of the $20,000 and you'd only be left with 10. That's actually not the case. What happens here is there's another player in this equation, and that's the life insurance company. They allow you to borrow their money and not invade your account and stopping the compound effect. So this is huge. You're able to use their money at a very, very reasonable rates, and your money still stays intact, growing on the full $20,000 as if you never spent it. I mean, how good is that? You can't get that with anything else. So again, if you have a $10,000 purchase, the insurance company, they're going to say, you know what, we know you're good for it, Mr. and Mrs. Client. You know you got $20,000 with us, and of course you've got a death benefit of maybe $100,000. So we know you're good for it. What they're going to do is they're going to lend you the money out of their pocket at a simple interest rate. Most people don't even know what that is. Simple interest is the best interest you can get on a loan. It's going to be simple interest once a year. And let's just assume it's 5% for today's video. It's really 4.76 with some companies and maybe a little bit higher with others. But today's video, let's just say 5% flat. Simple interest once a year. And if that was $1,000 that you were borrowing, that'd be $50 for the whole year that you're paying in interest. But you're still earning what? Compound interest at 4% on your entire 20. Not 10, the entire 20. How beautiful is that? So we look at this as financial advisors and we say, how beneficial is this? If this was maybe a credit card at 15% and you had the money here, you took this and paid off that credit card, the idea is to pay yourself back exactly the same payment you were paying Visa or MasterCard. Don't rob yourself out of the 15%. You were okay with paying anybody else it. Why can't you pay yourself that exact same payment? This is where we call yourself the banker in this equation. You've essentially become your own bank. You're borrowing the money from the insurance company. They're charging that 5% on whatever that amount is. You're earning the entire 4% on the entire $20,000, and take it a step further. What we're going to do now is pay yourself back at 15%. The first 5% will go back to the company, release the lien off the loan, pay them the interest for the use of their money, and the additional interest rate goes to who? You. Back into your pocket, making your account grow even more. Tell me any other vehicle that allows you to do this, please. I would love to hear it, because today, this is the best vehicle that allows you to pay off debt, snowball it, pay yourself back all the interest you're losing, and at the end of the equation, you've got an account that's tax-free, guaranteed, and of course, you get to use it for whatever you want to between now and retirement. With that, ladies and gentlemen, this is going to be concluding today's video, but I want you to always think about subscribing, click the link for the next videos. We're going to have hot topics on really how to get ahead financially, make smart money moves in today's economy, and get yourself in a better position. Thank you for joining, and again, please subscribe.